Hey everyone, I'm back with another dividend stock investing video. I want to share with all of you 9 dividend stocks that I personally own in my stock portfolio. As you can see on the screen in front of you right now, these 9 stocks comprise the smaller positions in my portfolio. Many of these stocks are higher yielders like BP at 4.49% dividend yield and IBM at 4.97%, Bank of Hawaii as high as 6.7% dividend yield, but many of these stocks are lower yielders as well, like Utz Brands Inc. at 1.41% and CARR at 1.49%. What unifies all of these stocks is that these were all stocks I considered selling recently because they're smaller positions in the portfolio. Recently, I did a portfolio cleanup and I actually sold about 15% of my stock portfolio by value. I did that to fund a real estate purchase, and I have a lot of videos on that already, so I'll share those in the pinned comment below, the first 2 videos in this 3-video series. But in the video today, I wanted to share the 9 stocks that I did not sell. These 9 stocks were all up for consideration. I was thinking of selling these 9 stocks, but I did not sell the 9 stocks that I'm going to cover today. And I want to share my thought process, why I continue to hold these 9 stocks, why I sold others, but I did not sell these 9 stocks. Why did I keep these particular stocks? And so I look forward to going through that in the video today. Welcome to ppcian. This is dividend stock investing for everyone. All right, everyone. So I just want to share the 9 stocks on the screen again. As you can see in front of you right now, there they are. I'm just going to leave it up there for a minute while I talk. The first thing that I wanted to remind everyone is to please check out the pinned comment below for the first 2 videos in this 3-part series, but also check out the pinned comment below for a link to my Patreon. Over on Corner Patreon, I share my complete dividend stock portfolio with percentage allocation to each position, and I plan to update that portfolio pretty soon here. I also have Zoom meetups on Corner Patreon, and I plan to have a Zoom meetup once my new portfolio is published. But as you can see on the screen in front of you right now, that's it. Those are the 9 stocks that I considered selling, but I did not. Now, these 9 stocks comprise 6.1% of my portfolio. So if in addition to that 15%, I needed to raise even more capital, this is another 6.1% that I could have raised, but I did not. Thankfully, I held on to all of these stocks, and these stocks comprise roughly 5.5% of the portfolio. And so I want to jump into them. I want to go through them one by one. And so let's do this. As you can see on the screen in front of you, the first one that I considered selling, believe it or not, was Caterpillar. Now, the reason I thought of selling this one is I had a preconceived notion that it was probably overvalued because this stock, as long as I've owned it, has gone up and to the right. And I felt right now, which is kind of a tough time for cyclical companies, it's a tough time for industrials right now. I had just assumed, I'd made the assumption as someone who had a portfolio of 50 stocks, I had just assumed, hey, it's probably overvalued. It's probably not doing that well because of cyclicality, because it's tied up in that industrial type of sector. But when I looked at the metrics, it was actually doing just fine. I started buying this thing in the mid 80s in 2013. I bought as low as $60 range in 2015. It's at $246 now. And so it has gone up and up and up, and it has almost defied logic because I haven't seen too much cyclicality when I look at the numbers. In fact, when I look at the PE ratio, right now, the forward PE is expected to be in the 13s, even as we potentially head into recession, potentially we head into a Fed-induced recession here. Well, the analysts, unless they're completely wrong, believe that the forward PE on this is in the 13s. And whereas the dividend yield, the starting yield, it's not very high, it's at 2.11%, there is a lot of dividend growth ahead with business growth, but also just with increased payout ratio possibly, because the payout ratio is only at 29%. Look, this is why it's so important to look at the numbers and not just rely on intuition, not just rely on where you think a particular company is at, because Caterpillar, it has vastly outperformed my expectations. And for me at this point, I was targeting it because it's one of the bigger, smaller stocks in the portfolio that, hey, I just sell it off. I raised that capital. But no, I decided to hold because the business is strong. It has been a strong yield on cost opportunity for me as well. I've been in it for a long time. I decided to hold, and at this point, it's really off the table. Let's just say hypothetically, I had to raise more money, and I don't plan to at this point, but let's say something in life happened. I had to raise more money. This one's really completely off the list at this point. Caterpillar is a long-term buy and hold forever for me, and it took a little bit of added research just to refresh my opinion on this particular company, that it's doing really well, unlike some of the industrials that I did sell, like 3M and Leggett and Platt. But let's keep going. I have another one I want to share. As you can see on the screen in front of you right now, the next stock that I considered selling, but I did not, was Wal-mart. And so this stock comprises 1.1% of the portfolio, so it's one of the bigger small stocks in the portfolio. This stock over the years has been disappointing because dividend growth has been really, really slow. In fact, the 5-year compound annual average growth rate of that dividend over the last 5 years has been only 1.9%. Now, by contrast, Caterpillar was 8.6%. So Caterpillar, it was a no-brainer for me to keep it because not only is the PE low, not only is the payout ratio low, but they're growing the dividend really quickly. It's a yield on cost play, and I've been in it forever, so I've locked in gains as well, which are something I would prefer not to sell and have to pay taxes on those gains as long as I have not sold their unrealized capital gains. And Walmart, by contrast, though, the dividend, it's growing slowly. Now, what's similar with Walmart as to Caterpillar is I'm up a lot. Right now, Walmart is trading at $156.09, but I started buying this thing in 2009 at $49.82. So I'm way up on Walmart, so similar line of logic. There is a tax impact potentially to selling positions in the dividend stock portfolio, and I wanted to really balance the gains with the losses to hopefully cancel them out. That was part of my consideration when I was selling. And Caterpillar and Walmart, they were large gains that I did not feel comfortable selling and taking at this particular time. And so that was certainly part of it as well. But I'll tell you, whereas Caterpillar was so exciting for future growth and for valuation, look, Walmart right now is trading at a forward PE of 25. Long story short, why I decided to hold Walmart is it was a more emotional attachment for me. This is one of the earlier stocks in the portfolio that I started buying. This is one that I started buying way back in the day, and I have an attachment to it. Now, I do think it's a disruptive business. I do think they are in retail, but they are doing a lot as it pertains to technology and automation and looking at the forefront of what is ahead. That said, across our total portfolio, we've got some exposure to retail. And so did I really need to own Walmart's given all the other exposure to retail? Probably not. But again, these are the challenges that come to play when deciding whether to sell stocks or not. These are the real world considerations. And sometimes it just comes down to the fact that, look, I've got a large gain and I don't really have something else I want to sell that would cancel that out for tax purposes, but also I'm kind of tied to Walmart. And so that's why I'm decided to hold that one. That's really off the list of consideration at this point. If I ever had to sell in the future, which I don't plan to, it's really off the list. But let's keep going. As you can see on the screen in front of you right now, the third stock that I wanted to present today is BP. And so BP is 1% of the portfolio. And honestly, I didn't have a great reason to consider selling this stock, other than the fact that, hey, I've got some other energy positions. I've gone Chevron and Shell. Maybe I slightly prefer those. I vastly prefer Chevron. That's my favorite energy position. But that being said, it's it was potentially a way to gain 1% of the portfolio value, which is a good chunk, and add to that list of sales. But when I started digging into BP, I decided to hold. And it's not maybe as strong of a hold as the first two. I mean, Walmart and Caterpillar for me are strong holds. I'm not going to even consider selling those. If something were to happen in the future, I needed to raise capital, maybe I'd consider selling BP, but I have some others I'd probably sell first. But anyways, with a forward PE of 6, with a meaningful cash flow right now, it has a 4.9% dividend yield right now. I use that cash flow right now to pay bills. Now, energy is a boom bust business. We all know that from the pandemic, and these guys are still recovering from the pandemic. The dividend, I think, will continue to grow over time. I see some value in this sector right now. And also I see this energy sector as a hedge of sorts, as a diversification play, as a way of rounding out the portfolio. And so certainly, whereas I'm overweight in retail, having stocks like BP, I like having that because it rounds out the portfolio. It gives me that diversification in the energy sector. And so ultimately, I decided to keep this one based on valuation and also based on the huge yield, but also based on the fact that the role that it plays in the portfolio of rounding it out. By the way, if you enjoy the video so far, please put in the comments below what you think. And also, I would love to know if you've ever sold stocks or considered selling stocks. What does your thought process look like? I'm just sharing my thought process out there for fun and entertainment. This is not investment advice, just sharing my personal journey, but I'd love to share it and get your feedback. Do you have a similar process? Do you have a different process? How do you go about selling stocks if you ever need to? I'd love to know in the comments below, but let's keep going. As you can see on the screen in front of you right now, the next stock is IBM. And so this is a funny one. Peter Lynch always joked, he's the famous investor, probably my favorite investor of all time, the captain of the Fidelity Magellan Fund in its heyday. And he said IBM was always in his portfolio just because it was kind of at the time the funny thing to do. All the mutual funds had it and it was always a loser, but they always had it. And I guess in harnessing my inner Peter Lynch, I have IBM. I didn't sell it. It's 0.9% of the portfolio. The stock has not really gained any traction or a lot of traction despite new management over the years. I hope to see it gain more traction. Long story short, the reason I kept this one is for the 4.97% dividend yield and for the fact that it brings technology exposure to the portfolio, because I did sell stocks like Apple and Alphabet, and so I wanted to have that technology exposure. And so certainly it has a reasonable valuation with a forward PE of 14.22 this year. And so I don't think that it's overvalued, but the 5-year dividend growth rate on average is only 1.1% per year. And the reason for that is the business performance has been lackluster. They have been basically treading water and really trying to find growth again, trying to find their way into growth. But again, I decided to keep IBM at this time just to have the tech exposure and to have the yield that I use to pay bills right now. That being said, if I ever had to raise capital again, say there was some other business venture opportunity, some reason to raise capital, and I don't foresee that at this point, would I sell IBM? Probably. That's probably the one that's at the top of the list right now out of all the stocks I own, that it's maybe my least favorite. It's the one where I'm not very excited about the future business prospects of the company, just because I've seen different management teams come in and all of them, it seems like they're having trouble gaining traction, gaining momentum in terms of revenue growth, earnings growth, product adoption out in the marketplace. But let's keep going. What's the next one on the list? As you can see in front of you right now, this one is a stock that I have a lot of exposure to, this industry of snack foods, salty snack foods. It's Utz Brands Inc. And we're jumping all the way down to 0.5%. This one only represents 0.5% of the portfolio, whereas IBM was 0.9%. And so we're jumping way down. It's literally the only reason I considered selling this thing. And most of the stocks that follow, or all of the stocks that follow, is due to size. When I have something that's 0.5% in the portfolio, it takes up mind share to manage that. Also, I was thinking, hey, I do have an overexposure to snack foods. I've got many others in the portfolio, including PepsiCo, which is one of my largest positions by far. And so I considered selling, but ultimately, I realized I don't mind having an overexposure to snack foods because snack foods is a great category, and it's a category that I understand and that I've been successful at over the years. And so I realized sometimes it makes sense to double down on my winners, double down on my winning categories. Now, so far, Utz Brands Inc., it hasn't been a winner, so to speak, but I think it will in the future. I guess it's been a winner in terms of dividend growth, but in terms of share price growth, I think it'll take some time for it to kind of work its way into its current valuation. It does have a forward PE of 30, but the reason it has a forward PE of 30 is they're growing very quickly. And the 5-year dividend growth rate or actually the 2-year with them, because they don't have 5 years of publicly traded experience, has been a solid 6.8% over the last 2 years of dividend growth. And so that's pretty solid at 6.8% compound annual growth rate, reflective of the fact that they're growing their business really quickly. Long story short, the reason I kept Utz Brands Inc. is I want that exposure in the portfolio as well to a small cap, high growth dividend stock. This is a yield on cost stock. This is a multi-decade stock. This is a stock that's in an industry, again, that I understand very well and that I've been very successful at over the years, as in the case of PepsiCo. And so that one is solidly off the sell list. That's kind of like some of the others I talked about in the video today, like Caterpillar. I just couldn't bring myself to sell it, even if I needed to raise capital. It is in a different league, in my mind at least, as compared to something like an IBM. But let's keep going. The next one is a definite no sell, but as you can see on the screen, I had to consider it. It was a carrier, and the only reason I considered it, again, is only 0.5% of the portfolio. But boy, this thing has vastly exceeded expectations since it was spun out of United Tech. Long story short, the 3-year compound annual growth rate on this thing has been 32.2%, which is hard to believe. It is out of this world. This is a stock that has vastly outperformed expectations. And what I've really realized with this particular company is it's trading at a fair valuation. Look, it's at a PE of 19 forward this year, 17 next year. I'd say it's not overvalued, but it's certainly not undervalued. But what I looked at is, even though it's small, when it was spun out of United Tech, I told myself I'm going to manage Carrier, Otis, and Raytheon Tech, which is the new version of United Tech, as one. They're 3 separate companies, but they're really one. And the reason that's important is, for me, United Technologies, it used to be one of my top favorite dividend stocks of all time. If you remember those videos, by the way, please smash that like button if you've been around that long since those days. I'll try to dig up those videos and link to them in the pinned comment, but this was like years ago. It was one of my favorite stocks, and when the spinoffs happened, when the reorg happened with Raytheon, I said, hey, Ian, you're going to manage it all as one, and you're not going to sell off Carrier and Otis. But I was thinking, hey, when I actually have to raise capital, hey, Carrier's a small position. But I was reminded, no, you said you were going to manage it all as one. And when you just look at it standalone, the company, it's kind of trading at a fair value, but it should be, because they're growing so quickly. They're doing so well. It has flourished as a standalone company. So of course, I'm not going to sell Carrier. It's just way off the list. I think out of everything I've discussed in the video so far, I like this stock even more than Caterpillar in some ways. And so for me, this is a definite no sell. And the next one that I considered, as you can see on the screen, is its sister company, Otis. Now, of course, I only considered it because it's 0.4% of the portfolio. Now, Otis has not grown the dividend quite as quickly. Its 3-year compound annual growth rate of the dividend has been 19.3%, but boy, that's still the second best on the list after Carrier. How could I sell such a winner? That's the way I look at it, is in my portfolio, even at a fair valuation, even at an overvalued valuation, I will not sell a winner. And I guess the one exception recently was Apple. That's a clear winner, but I felt it got kind of not only overvalued, but it was such a big component of the portfolio that it lowered my overall weighted average dividend yield, because the dividend yield is so low. And so, by the way, let me take a quick coffee break here. This is one I'll never sell. Starbucks, even though right now I'd say it's at a fair or overvalued level, I will not cut a winner. And so now there are exceptions like Apple, just because the dividend yield was so darn low. But anyway, let's keep going. And so I have a few more stocks to share in the video today. Check it out on the screen. The next one that I considered selling was another really small position. Obviously, I didn't sell Otis. It's in the same bucket as Carrier. No way. The next one was Bank of Hawaii. And the reason I considered selling this one, again, wasn't really anything other than the fact that it's just so small. It's only 0.3% of the portfolio, but also regional banks are under a lot of pressure. We're in a society right now where winner takes all. We're in a society right now where the big banks are the place to be. But ultimately, I decided to keep it because it is trading right now at a forward PE of 9.76. The dividend yield right now is 6.7%, so it has the highest dividend yield on this entire list. Now, I don't expect the dividend to grow. It's never been a dividend growth stock. I decided on this one to take a little conscious risk. Yes, is there potential risk with this company if there was a run on the bank? If there was a run on the bank, I know they have a lot of their wealth tied up in treasuries. I'm assuming the treasuries, some of them at least, may have longer durations. Maybe the value of those treasuries is less than they paid, and certainly it would be what they paid if they can hold it to maturity. But if there's a run on the bank and they have to liquidate treasuries, I don't know if Bank of Hawaii would be in the best position. I looked at their balance sheet in a number of videos back, and I saw some risks there. But the reason I'm taking on conscious risk with Bank of Hawaii is the fact that, one, I don't have a lot of exposure at all to financials. So that is one of the ways I have exposure to financials. But also I see some value there. It's so small anyways. Honestly, if I had to sell something other than, say, number one on the list would be IBM, maybe I would put Bank of Hawaii on the list in the future. But it was one of those stocks that's way down that I also couldn't see myself selling at such depressed levels. Yes, it's down because of risk, but also I believe that that risk will likely go away. I don't see a run on the bank happening with Bank of Hawaii. It has a unique position in Hawaii where it has a stronghold on that particular market, and I just don't see the good people of Hawaii going there and running on the bank. Where else is the money going to go? This is Bank of Hawaii. I was just on Maui, for example, and when you go around, there are not a lot of large banks there. It's really more regional banks. And so it's a market dominated by regional banks. And so I just see if there was a run on the bank, where would the money go? There's not a lot of options. And so that gives me some comfort as well that there probably would not be a run on the bank. But that's the risk with a small regional bank these days. But ultimately, I decided to hold. And I'm going to enjoy that dividend, which is quite nice at these levels. And maybe buy a little more, but most of the new funds I have right now are going into SCHD, as my patrons know. I share my trades over on Patreon, by the way, not only on Corner Patreon, which is the higher tier, but Backyard Patreon as well. So let's go ahead. Last one, as you can see on the screen in front of you, this rounds it out with number 9. Number 9 that I considered selling was Hasbro. And this one, again, it's only 0.2% of the portfolio. Really, really small. I also decided or considered selling this one because it's had lackluster business performance over the last few years. They've had some hiccups. They'd had some troubles. For a while, they had this golden brand, Magic the Gathering, and it was propelling the business forward. But at a certain point, I haven't done enough research, honestly, with a company that's only 0.2% of the portfolio. I don't look at it that closely, to be honest. But my understanding is they've had some hiccups over the last few years, and it's fallen in share price. And thankfully, though, the forward PE is a 14.53 this year. Thankfully, it is a 4.33% dividend yield, so I'm getting paid to wait there. I don't think it's overvalued. Certainly, I think it might even be a little undervalued. Now, the dividend growth rate over the last 5 years has only been 2.1% on average per year. So because of the lackluster business growth, they've been slowing their dividend growth as well. And I would say overall, with Hasbro, historically, it's been a high growth dividend stock in the portfolio. It's been more like an Utz Brands Inc., where I would expect, or a Carrier or Otis, where I'd expect the dividend to grow quickly, like around, say, anywhere from 6 to 10% per year on average, but it's slowed down. I would say with Hasbro, it's kind of falls in the camp of IBM, and Bank of Hawaii. If I had to make a deeper cut in the next round, if there were a next round and I don't expect that, that would be the three. But for now, I'm going to hold it. Something that also happens with Hasbro is that's a stock my kids own. And so I don't really have to own it myself because the family has exposure anyways. It's a really long-term hold for the kids because they love the products that Hasbro sells. And that's a whole topic for another video, investing for kids, investing for family, and helping kids get started really early on in understanding the basics of investing. One of the core pillars of that strategy is I always like to purchase stocks for the kids that they understand, that are tangible, that they have experience with, that are also good companies. Now, of course, I'm speaking about 9 companies today that I considered selling, but these are all, in my opinion, really great companies. I only own great stocks. It's just within the universe of stocks I own, these are the 9 that are kind of smaller in the portfolio. They play a role, but they're not quite as high quality, of course, as something like a PepsiCo or Starbucks for that matter. But anyway, with investing for the kids, I try to buy the stocks that are related to brands that they own and that they love, like Hasbro toys. And so put in the comments below, have you ever considered selling stocks? What's your strategy for selling stocks if you are in a situation where you have to raise capital? I'll tell you, going into all of this, I'm a dividend investor who uses capital to pay bills, uses cash flow to pay bills. And I generally buy with the premise that I'm never going to sell, but life can throw a lot of surprises one's way. Life can change. Life can be dynamic. And sometimes the dividend investor who does not even anticipate selling might find himself or herself in a situation, hey, I've got to sell. And so that's what this video series has been all about. I thank you for sticking through with this 3-part video series. I hope you did enjoy it. And I look forward to starting something fresh in the next video, a brand new topic for all of you. But before we go today, I want to do my disclosure and disclaimer. In terms of full disclosure, I do own the 9 stocks mentioned today. I am, and all the other stocks, or most of the other stocks I mentioned, I am long Caterpillar, ticker CAT, Wal-mart, ticker WMT. I am also long BP, ticker BP. I'm long Shell, SHEL. I'm long Chevron, CVX. I am also long IBM, ticker IBM. I'm long Utz Brands Inc., UTZ. I am also long Carrier, CARR, Raytheon Technologies, RTX. I'm long Otis, OTIS. I am also long Bank of Hawaii, BOH. I am long Hasbro, HAS. I am long SCHD, the ETF. I am also long Raytheon Technologies, RTX, and PepsiCo, PEP. If I missed any of those, I will put it on the screen as I always do. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey for fun and entertainment. This is not investment advice. I'm sharing my journey with all of you. And I have additional disclosures, disclaimers in the description below. As always, I love you all. I can't wait to see you in the comments below, and I'll see you in the next dividend stock investing video.
Oh.